Hello everyone, I'm Sachin and welcome to Investing with Sachin series. I have launched this series to give you a bit of insights into how do you go about value investment, how do you find the companies, what parameters goes in analyzing those companies. By no means this is an exercise or a recommendation to invest in company. I would strongly request you to do your own research, do analysis and then decide on the investments, because every individual has a different risk reward profiles. Everybody has to do its own research. This is no means a recommendation. Today I picked up one of the UK gems, digital gems, on thebeach.com. It's a company which is active in UK market for a while, and they are a package tour operator. When you look at it, they are competitors to Loveholidays, Jet2, TUI of the world. Their focus has been on the beach holidays, and that's where they got their name in. It's a low asset model. They operate via the airlines and the hotel operators without having much of the assets on their books. They have started growing in Ireland, so they launch beach holidays in Ireland market. They are launching city breaks nowadays. So if you want to go to Amsterdam, Budapest, Paris, there is a city holidays offers on there for UK and Ireland customer. And they've recently launched cruise holidays as well. So I can see one digital platform expanding with multiple products, giving them a higher runway for a top line growth, larger revenue share and a wallet share from the customers. When you look at their market cap, they are £330 million business, trading at 220, 230 odd P. Their net cash position is 91 million. There is no debt on the business. Business operate on a negative cash flow basis. The earnings are around 25 odd million, generating 13.5 P by E. If you look at net of cash, it's operating or trading at a 10 P by E. In my opinion, a double-digit growing company operating at such cheap valuation, with such an expansion possible with the new products, new regions, is a steal, right? Going deeper into the numbers. So if I have to look at the recent financials and how they're operating, right? If you look at the TTVs, which is the total transaction volume booked on the platform, it is around $1.25 billion, growing at 11-12%, leading that revenue growth of 6% at 120 odd million, and adjusted PBT close to 35 million. Then all of that generating an EPS of 19p, a free cash flow of around 28 million. And again, if you look at a free cash flow basis, net of cash, it's almost generating 28-30 million free cash flow on a 240 million net market cap. In my mind, that's a phenomenal return. On a $240 million, 28 to 30 million cash return is circa 11% free cash returns. Secondly, they are a dividend paying company. Dividend yield is not high, and dividend yield is close to 1.52%. But if you look at last 1 year, they have done a 50 million buyback, which means that almost 14% of equity has disappeared from the market. And if you look at a buyback yield and a dividend yield, almost trading at a 10%. I would just like to finish on the management part before I complete this summary. If you look at a management wise, Simon Cooper, who's a chair and a founder of a business, he still owns and holds 7%. He still has active interest in company, which is very, very important for me. That founder is involved in driving the business. There are top 25 shareholders, circa holds 87%, and you have who's who on the shareholder list from the big fund managers and everything. So top 25 shareholders owning 88% share, which is a good sign that the business has been seen in good light. Sean is a CEO of a business. He's in the business for last 2.5 years, doing very well, I would say, from a strategy perspective, growth perspective, driving business perspective. He also, as a part of this business, he do have small ownership in the business too. So if you look at 2025, right, I think last year they started picking very well. The share price recovered significantly. At a point in time, it was 280, 290p with all the buyback and all the market action. But during October, November, they had a couple of announcements in the market. They said they're going to miss on the PBT target by a couple of millions, and the main reason for that is their B2B business was not doing well, and they decided to sell it off as well. If you ask me, Yes, it's a profit warning or mild profit warning, but it is in a segment where they don't have a focus. They want to take it off. If you look at that blip, market did not take it well. The share price dropped from almost 280 to 90p all the way back to 180p. And that did present an opportunity if you ask me as a long-term investor, because getting out of a B2B business, low margin, no focus, is a good sign from a long-term perspective. And management has put it on a sale. So effectively, when I look forward, it is still a double-digit growing business, cash generative business, generating free cash flow yield of around 11 to 12%. There is a good intent to return the cash if the share price drops too low. In my opinion, if it remains at around 220, 230 level, they will keep on buying all the time, right? And that buying back is almost of the tune of 10% in a year, which is significant. 25 million they want to deploy the cash. So all in all, when I look forward, double-digit growth in top line, double-digit growth in bottom line, double-digit growth in free cash flow. All that leading signs to me is that the business is headed for a higher valuation, and I won't be surprised if you see something of £4 starting sign at the share price in next 24 months, which obviously from today's price almost 50 to 60% return for the investor, right? What are the risks? What can go wrong? As you can imagine, first of all, the consumer confidence. If the economy has become difficult, if we hit the recession, the travel goes down, people are constrained on holidays, then yes, they will take a hit on booking and they will take a hit on bottom line. But again, that's a temporary blip in my opinion. People love holidays, especially being in London, UK. Everybody wants to have summer holidays, winter, summer. So all the holidays will kick on, and even if blip happens, there will be temporary blip. The competition. Yes, there is a competition in play, but they have proven brand, proven marketeer, and going well. Third thing is expansion could go wrong, but if they realize it's not working well for them with a minimal investment, they can scale it back. So all in all, even if it doesn't grow, you have 12% free cash flow yield. As it's going to grow, the yield is going to go higher, automatically giving us higher valuation, higher returns. So I would say 80-90% confident that it will do well in coming days. And as I said, £4 starting share price would be something we can aspire for in next 24 months. If you found what I said is interesting and useful, please like and subscribe my channel so that you can keep updated about forthcoming series and the discussions on this channel. Thank you very much.